Hello all, welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani here. The big sector rotation, well, we've seen it starting this year, and it's increasing interest in one area of active management, and that's market timing. Can you successfully move in and out of sectors and actually make money doing that? Let's talk to Kim Arthur. He runs the main sector rotation ETF, the symbol is SECT. Wes Krill is the Vice President of Research at Dimensional Fund Advisors. He's been studying market timing efforts for decades. Dave Noddick, our old friend, Director of Research at ETF Trends, he also joins us. Kim, there's a lot more interest in market timing and rotation this year. I don't know if it's just in the air. Is that because we've seen so much rotation in different sectors this year with, you know, the reflation trade coming to fore and tech kind of taking a back seat?
Yeah, Bob, good to hear your voice. Yeah, there's definitely been a lot more in the air, as you say. If you really can pinpoint it, it started at September 1 of last year. And just to give you a real kind of like a real live data point there, from September 1 of last year, value through Friday, value's up 19%, 19, growth is up 2, and how about the Mag 5, Microsoft, Amazon, Apple, Google, and Facebook? They're down 1. They're down 1 during that time. Why has that rotation happened? We think that after people realized there was not going to be a double dip recession, rates bottomed in August, and as they saw them starting to move up, that's when you get the rotation that goes into the value and cyclical plays and the small cap. And it's been, historically, it's happened with that as people start to see real rates. We went from negative 45 basis points in the 30-year to where we're now positive 11. So all the tailwinds were all lined up for it to happen, and we're seeing the results, and we think it probably continues for a while.
Now, you've got this sector rotation ETF, SECT. You move in and out of sectors, ETF sectors, not stocks, and it's been outperforming the S&P year to date because you've had it seems like increased bets on banks, energy, and small cap ETFs. How do you decide when to rotate the portfolio? I don't mean like describe what's happened. I mean, when do you actually rotate more into energy and rotate out of technology? What criteria do you use? Just briefly describe that. I don't want to know how the market is doing it. When do you decide to get in now?
Yeah, great question. So there's 2 parts to it, Bob, in our process. The first is valuation. We're big fundamental value people here. So we've got all kinds of data on looking at sector size and style for its historical valuation, its price to book, price to earnings, and dividend yield. So we look at that, and it gives us a menu to choose from. But the menu alone is not enough. You need to have a catalyst. You've got to have a catalyst. So what we looked at with the financials, for instance, is a steepening yield curve typically has been very, very bullish for that. And then you throw on top of it where they were prohibited from buying back stocks, they were green-lighted in the middle of December. So that's another tailwind for them. Or on the energy side, you had 2 big things going on. You had 7% of the global supply taken out of the global area during the pandemic. And we know with the vaccine rollout that's going on here, demand is going to pick back up. So demand was going to exceed supply. But even more importantly, here in the U.S., we have an administration that is curtailing supply on federal lands where there's 20% of the supply that comes out of that. So again, it's the process for price, valuation, and then a catalyst.
You know, Wes, it's interesting to hear him talk about this. This kind of makes sense in terms of why rotate into banks, why rotate into energy. But Dimensional Fund Advisors has been studying market timing efforts for decades now. Could you summarize what you have found out? Summarize the research and the academic literature on market timing for us.
Yeah, thanks, Bob. Thanks for having us on today. Yeah, I think that just the greater kind of body of work that's been conducted on researching market timing strategies really goes back for about a half a century now, both from academics as well as practitioners. And whether they're looking at it through the lens of stock picking, whether it's looking at the performance of active mutual funds or whether it's looking at asset class timing strategies like managed futures types of approaches. By and large, the evidence points in the same direction, which is that these strategies tend to underperform passive benchmarks. And I think that, to Kim's earlier point, it's important for investors to be cognizant of the potential opportunity cost of trying to time markets, because for something like the value premium, we see that historically it has often showed up in large bunches very quickly. If we look back at the calendar year average for value versus growth, values outperform growth by about 4% per year. In years when that premium was positive, the level of outperformance was over 3 times that amount. And we see it even when we're just looking at the broad market. If I look at the growth of wealth for the U.S. stock market, starting in 1970, going through the next 50 years, your total growth of wealth, if you missed out on the best day for the U.S. market, just one single day, your growth of wealth dropped by about 10%. And so again, it's important for investors to understand what the potential implications might be if they do try and outguess markets. And this is consistent with a very competitive marketplace. It's incorporating millions of trades every day, accounting for hundreds of billions of dollars. And that's a very comprehensive price setting exercise. And that's what you're up against when you do try and outguess markets.
Yeah, I want to keep that. I wonder if we could put that up, that hypothetical growth of $1,000 invested in the S&P, because in my mind, this is the easiest way to explain to people why market timing doesn't work very well. And the way you do it is just look at, if you're not in the market on the best days. Now, Wes, you provided this information to us, and I thank you for it. So this is the $1,000 invested in the S&P 500. Pick it on the first day of 1970. The total return you had today would be $138,000, believe it or not, in 1970. That's $1,000 invested in 1970. Just buy and hold the whole thing here. Wes, does this include dividends, the total return there? That's a total return, right? So it includes dividends, correct?
Correct. It is total return. So this is a good reflection of just what investors could have captured.
Let me just finish the point. I'll jump back in, Wes. So if you take out one day, the single best day in the last 51 years, you only have 124,000 instead of 138. If you take out the 5 best days in the last 51 years, you only have 90,000 instead of 130. If you take out the 15, you have 52 instead of 138. And if you take out the best 25 days, you have 32,000 instead of 135,000. This is, to me, the easiest. The problem, of course, as you have written before, Dave, my old friend, you've written about the folly of market timing. The problem is nobody knows what are those best 25 days that are out there, Dave. And so, therefore, logic tells you that it's very difficult to figure out market timing under any circumstances, Dave.
Yeah, and I think this is also behind the rise of low volatility investing, because, of course, the math works the same way on the downside, too. If you miss the 10 or 25 worst performing days, you obviously massively outperform on the upside. And that really gave birth to a whole raft of strategies that sought to exclude all of the outliers and, quote unquote, smooth out your ride. And those strategies really haven't quite delivered the way people wanted them to in the sort of recent spikes of, VIX over 20. So I think it's reasonable for people to look at the market, see these outliers, and figure that there must be a better way. History would suggest there really very rarely is a better way. But, it's the Lake Wobegon problem. Nobody wants to be average, even though they know on average they're going to be. And certainly if you're a professional investor who's being paid to advise clients, it's very difficult to build that business on the back of trying to be as average as possible.
Right. Now, Wes, I wonder if we could put up that screen that indicates that long term, the stock market tends to outperform. It's up year over year. The S&P 500 since 1928 has been up 72% of the time. That's a pretty good average, Wes. But as you know, there are years, and in some cases many years, when it underperforms. Owning the broad market, and there's your statistic. This is people ask me, is the stock market a good investment? I say 3 out of 4 years it tends to move up, but that doesn't mean it goes up every year. So owning the broad market, Wes, seems to be the right play. But if market timing doesn't work, and I think we can agree that it'd be difficult to make it work, is there anything that does outperform? What has your studies shown? Obviously, you guys have emphasized value and small caps. Is there any evidence long-term that would be a better strategy than just owning the broader market? What outperformance can you possibly get out of the market?
Yeah, certainly one way you could outperform markets is if you could predict when those negative years are going to occur. Of course, this half century of historical evidence suggests that people can't consistently do that. But then the key point for investors to remember is you don't have to outguess markets to outperform them. And this is a function of not all stocks having the same expected return. Just like when different investors go to get a loan from the bank, they're not all going to receive the same interest rate. It's similarly for different stocks, they don't all have the same rate of return that's demanded by investors. And we can see just through the principles of valuation that by combining variables related to the price of a stock and what we expect to receive in the future in terms of cash flows, we can identify these differences systematically, these differences in expected returns across different stocks. And by emphasizing these stocks with higher expected returns, so stocks that are smaller in market capitalization, are lower in valuations, for example, price to book, and higher in profitability, we can identify a subset of the market with higher expected returns and outperform just by using market prices and without trying to outguess or figure out where the market got things wrong.
Yeah. The other thing I think that's very important to point out to people, and they ask me all the time about this, what's the evidence? And I say long-term, stocks outperform bonds. You want to own generally, unless you're towards the very end of your life, you want to have a heavier weighting in stocks than bonds. And I wonder if we could put up that full screen, a dollar return since 1926. Again, Wes and Dimensional has provided this to us. It's rather remarkable. If you put a dollar going back to 1926, inflation would make that dollar, essentially it's pumped that up to $14. But long-term government bonds, remarkably, only $175. I find that amazing. But a dollar in a large cap portfolio would net you a little over $9,000. Small caps, $25,000. Amazing. Two things here, Wes. Number one, 175 in long-term government bonds. That's sort of incredible. But small cap, over very long periods of time, still outperforms big cap, even though the last 10 years that has not been the case overall.
Yeah, it certainly hints at just the awesome power of markets and the ability for equities to help investors to get to their goals in many ways. If those goals involve how much their current savings can be used to afford consumption in the future, there's certainly an element of growing your invested savings. And the stock market has been a very great avenue. Just in the U.S., when back in time, you're looking at about an average return of 10% per year for U.S. stocks. And that is a very important contributor to many investors' long-term goals. And again, it gets back to this premise of trying to guess when the markets are going to be negative. Well, if you end up missing the days when they're positive, those numbers you just showed on the screen might look substantially less impressive for an investor who is on the wrong side of the market timing.
Yeah. So, Kim, let me just, I think Wes's point is very well taken. It's very hard to beat the S&P 500. Your sector rotation fund is beating the S&P this year. You've been around a little more than 3 years. It's done well. It's not outperformed the S&P in 3 years. I see it up 50% versus 56% for the S&P 500, but it's not bad overall. You have a slight overweight, it looks like, in financials and healthcare this year, and an underweight and an overweight in energy too. I guess the issue is we still have demand for this kind of rotational vehicle at this point. And it seems to me like this is having a little bit of a moment. Does this happen because we suddenly have seen these sort of very quick moves in sectors and as a result we have people talking about it more? Or is this just a part of a Reddit meme thing where people are suddenly just more interested in playing around with the market and active management in general?
So Bob, first of all, what I would say is I totally agree with the whole narrative here that, we tell our clients it's time in the market, not timing the market. But under the cover there, again, we think that valuation does matter. So you can rotate from expensive factors into cheaper factors, expensive sectors into cheaper. Let's not forget back in the 2000 bear market of the NASDAQ, from March of 2000 to March of 2002, before the recession took everybody out, the NASDAQ was down 61%, but the Value Line Composite Index, its multiple went from 10 times to 18 times. As one of your other colleagues on CNBC, Jim Cramer, says, there's always a bull market somewhere. So what's happened with our SECT, which, like you said, it's only been out for 3 years now, but it has a separately managed account that's been around since 2002. So we have a lot longer sweep of time. From 2002, it's beaten the S&P because we think over time we have been able to rotate into it. But remember, since 2016, that large cap NASDAQ concentrated Fab 5, that dominated everybody's returns. If you didn't own that, you were not going to outperform. That over-concentration we don't think is healthy over the long term, and we think that's what you're seeing happening now as NASDAQ is now starting to underperform and some of these other cheaper factors, these cheaper sectors, are outperforming. So we think that, as you said, they're, energy, financials, value, cyclicals right now, they have more tailwind to go. As I mentioned, I may have mentioned earlier, the growth value, again, if you just take that factor, that in a 10-year sweep from 1995 to 2005, value went from, our growth went from being really cheap, and then in 2000 to really expensive, and then they cut it in half again. So these big cycles do happen in the past, and they will happen again because of the economy and price.
And Bob, I think there's opportunity here for active management, and I think that gets missed in some of the noise here, right? I think Kim's exactly right. The large cap growth space in particular has been effectively impossible for active managers to do much about. And if you look at things like the Standard & Poor's SPIVA reports, they would suggest that over the last 5 years, effectively no managers have really been able to carve out a hole there that they can dominate. But if you look at things like mid-cap growth and small-cap growth, active management's actually having a great run on a 1, 3, 5-year basis. The average active manager has actually beaten their benchmark if they're focused on that mid and small-cap space. So I think we paint the market with this very broad brush. And to Kim's point, I think that belies a lot of what's going on under the hood, and there's always opportunities.
Yeah, and Wes, maybe you can put a bullet point on that. You guys hew very closely to index-style investing, but you are active managers. You do have a value tilt, small-cap tilt as well. I guess the question is, how do you get people away from the get-rich-quick Reddit thing, where you can see, despite all the rhetoric about we've been oppressed and we've been disadvantaged, it does evolve into a get-rich-quick scheme, a lot of this Reddit stuff. How do you fight against that dopamine rush in the brain and encourage people to get rich slow? Do you feel you're making progress? I've been doing this for 30 years, and some days I feel like I think people sort of get it, and other days I feel like, oh, well, we're back to get-rich-quick pretty quickly.
Yeah, certainly you start by appealing to the financial science. And the financial science, to your point, suggests that we can manage investment solutions in an active way. And what I mean by that is you can take the best benefits of an index type of approach, the broad diversification, relatively low turnover, low expenses, and then you can add on an active component to it that helps manage risk and also increases expected returns by emphasizing segments of the market with higher expected returns. And the good thing about this is the premise behind pursuing these different premiums or emphasizing stocks that are lower in price and higher in profitability, that's a higher expected return proposition 365 days a year. I wake up every day believing that if I pay a lower price for a higher expected future cash flow stream, then that's associated with higher expected returns. And the evergreen nature of that logic is a really important component of the financial science. And then it just comes down to implementation, making sure that you're doing this in a low opportunity cost way where you're managing really the day-to-day changes and the costs associated with pursuing these premiums.
Yeah, very well said. And I want to pursue that a little bit more in the podcast. We've got to go, guys, but I want to thank you for a stimulating discussion. That's this week's ETF Edge, everybody. My thanks to Wes and to Kim and to Dave. And we're going to ask Wes to stick around. I want to ask him a few more questions about long-term investing and, of course, about active management. We'll talk a little bit more about that in depth. Remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.